Taxes are one of the largest expenses that we'll have in retirement, and yet we don't necessarily pay attention to them because we simply file our tax returns and pay them. But it's good to pay attention to your taxes in retirement because you have more control over them than you probably have ever had in the course of your lifetime. And I'm going to share 6 strategies that you should consider in planning for your taxes in retirement. Now, you want to remember that these are just general strategies, and the best approach depends on your specific financial situation. So it's always a good idea to consult with a good tax advisor, a good financial professional to better understand all of the implications and then make the best decisions for your situation. Hi, I'm Sally Boyle, founder of S.J. Boyle Wealth Planning, an advisor to families who are within 5 to 10 years of retirement. Okay, so the first strategy would be to live in a tax-friendly state. And this is one of the best strategies for saving in retirement because taxes on retirement income in these states are typically lower. They're more tax-friendly. And some states have no income taxes at all, or they have special breaks for retirees. Now, you want to evaluate all the expenses associated with moving to that state because you don't want to go because your income taxes are lower, but your property taxes are higher. So take a look at the total picture. But the first strategy would be to live in a tax-friendly state. Now, the second strategy would be to reassess your investments. You may want to change your retirement holdings, your investment holdings in retirement, because it can mean that you'll save on taxes and preserve your principal. For example, interest on municipal bonds is tax-free from federal income taxes, and in some cases, free from state income taxes as well. Also, what's called qualified dividends are taxed at a more favorable rate, capital gains rate versus an ordinary income rate, and yet not all dividends on stocks are qualified dividends. So taking a look at your tax return, understanding if the dividends that you are receiving on your investments are tax qualified or not tax qualified. And you'd like to find out exactly how those dividends can be better qualified for that favorable capital gains rate. Now, the third strategy might be to postpone distributions from retirement accounts. Postponing distributions from your pre-tax accounts can save you on your taxable income. For some folks, it makes sense to continue to defer those distributions because their earnings continue to accumulate tax-free. Now, you want to be careful because you don't want this to compromise for your accounts to become so large that your later distributions are taxed at a higher rate. So doing a proper 10-year projection makes sense for you. The other thing is to be strategic about your Social Security. Your benefits will be taxed, and they're taxed anywhere from 0 to 85%. And so what you want to do is to look at your adjusted gross income to see exactly where your income is and the impact that it will have on your Social Security taxes. And so $1 more than that 50% bracket means that all of a sudden you've increased your taxable income by 35%. So paying attention to where those brackets are, paying attention to your sources of income and trying to manage your income so that maybe only 50% of your Social Security is taxed. The other thing is you'd like to diversify. The fifth strategy would be to diversify your retirement income sources. And that means that you may be somewhat strategic about your pre-tax accounts and prepare for your required minimum distributions. In other words, sometimes people will delay their Social Security. They will take some of their distributions from their pre-tax accounts in those lower tax years because they don't have their Social Security income coming in, and they'll be able to diversify their income sources by putting some of their pre-tax money into Roth accounts. And so then they've got a variety of tax pockets to pull from when it comes time to plan their taxable income. Another strategy would be to use your after-tax accounts in conjunction with your pre-tax and your Roth accounts. Pulling from each to minimize your taxable income can be a good strategy. And again, something that you want to do a projection for to see exactly how mixing these different retirement income sources can benefit you from a tax perspective. And the sixth strategy would be to optimize your withdrawal strategy. If your main focus is tax efficient income, you may want to start considering taking distributions from your taxable account, then moving to your tax-free accounts, your Roth accounts, and then moving to your tax-deferred accounts. The same or the reverse can be true. You might prefer to take from your tax-deferred accounts first, then pull from your tax-free accounts and then your taxable account. It really depends on all of your income sources and which mix of those sources, as well as the sequence of those withdrawals, might minimize your tax liability. So again, these are 6 strategies to consider for minimizing taxes in retirement. And remember, again, these are just general strategies, and the best approach will depend upon your specific financial situation. Consult with a good tax advisor, consult with a good tax professional, and just note that this information is general guidelines and may not apply to your specific circumstances. But it's always good to seek some professional help to see how, again, you can mix your income sources, mix your income approach to minimize taxes in retirement.